People, welcome back. So, in this session, we're going to talk about the farmer's decomposition of performance. And again, this decomposition is a very important metric or a portfolio management strategy which is being used by every fund manager in the market. It might be used by some other terminology or names, but every fund manager is using this farmer's decomposition of performance to break down its alpha. So basically, what does the farmer decomposition of the performance simply tells you? It tries to break down the exit return or the alpha of a portfolio into the different components. It can be the return from an investor's risk. It can be the return from the manager's risk. It can further be a return from the selectivity, which can further be broken down into the return from net selectivity and the return from diversification, either extra diversification or lack of diversification. So every fund manager has the mandate to publish these numbers internally within the organization. The investment committee, led by the company's MD and CEO, specifically states the fund manager to state the breakdown on a quarterly basis and also upon the annual basis. Some fund managers still tend to calculate this number based upon monthly basis, but over a quarterly and an annual basis, this kind of requirement is mandatory. So basically, a fund manager gets to know, or the investment committee gets to know, that if a fund manager is yielding an alpha or delivering an alpha, how much alpha is coming from all these components. We'll try to understand these components separately. So again, this becomes like one of the most important breakdown in terms of the decomposition of the performance or the decomposition or the breakdown of the portfolio's alpha per se. Now it's a CFA L3 concept. Correct. Again, this method is also taught in CFAL3. We'll try to understand this method, like this method, with a simple classic example as well to make you understand this much more practically. ठीक है तो वो हम करेंगे but before we just try to break down the alpha we need to understand what exactly is alpha in the most simplest sense if somebody is entering into the market for the first time ever कोई अगर पहली बारी स्टॉक मार्केट में निवेश कर रहा है अपना पैसा पहली बारी मार्केट में लगा रहा है तो ही इज एडवाइज टू बी ए कंजर्वेटिव इन्वेस्टर इंस्टेड ऑफ गोइंग फॉर एक्टिव इन्वेस्टिंग or picking up direct stocks, the person is traditionally advised to invest into a passive fund or an index fund or simply as an exchange traded fund. Your performance it tends to replicate the index, the most safest kind of a security or the index or the benchmark in which you can invest into. It can be a Nifty 50, it can be a Nifty 500 if you want some exposure towards the broader market. It can be Nifty 150 mid cap index, it can be Nifty 250 small cap index. Correct. Similarly, the index funds are also present in the world of the fixed income market and the commodities market as well, which tend to track a specific fixed income instrument or a specific commodity, be it a gold or a silver. So, for example, if I talk about Nifty 50, the average 10-year CAGR for Nifty 50 has been closer to like 11-12% odd. So, for example, if you invest into Nifty 50, you can expect bare minimum 11% to 12% while investing into a Nifty 50 instrument or a Nifty 50 index fund or simply an ETF. That's a passive investing. You tend to replicate the market or your performance, your index performance, it tends to replicate the market. But if you want to make more returns versus the market, if you want to beat the benchmark, so for example, as I told you, if Nifty 50 gave me a 12% return, I invested into Nifty 50 for 10 years and Nifty 50 yielded me a 12% return pre-tax. Correct? So 12% ka I got a return from Nifty 50. Now, if me as an investor want to be a bit aggressive or at least a moderate investor, a person who is somewhere between a conservative and aggressive investor, and I want to get somewhere more than 12%, then I might prefer to go for an active fund. An active fund manager tends to beat up an index fund. The main aim of the active fund manager is to beat the index or the benchmark. So in this case, our benchmark becomes Nifty 50. So for example, if a fund manager is exposed towards like some kind of large cap stocks, अगर फंड मैनेजर एक्टिव फंड मैनेजर के पोर्टफोलियो में लार्ज कैप स्टॉक्स ही हैं सिर्फ लार्ज कैप स्टॉक्स और निफ्टी 50 एट द इंडेक्स इज गिविंग यू द एक्सपोजर ऑफ द टॉप 50 मार्केट कैपिटलाइज्ड कंपनीज इंडिया की सबसे बड़ी 50 कंपनीज जो हैं सो दैट यू विल फाइंड इन निफ्टी 50 नाउ इन एन एक्टिव फंड he might choose a few of the companies from Nifty 50, change the weightages to give you some extra alpha, to make you to yield an excess return for you to beat the benchmark. Correct. So, for example, if an active fund manager gives me 15% odd, so 15% is a return which is being generated hypothetically over a 10-year, 5-year basis by an active fund manager, and 12% has been the benchmark return. So 3% has been my alpha, 3% is my exit return. And the task of this farmer decomposition of the performance is to break down this 3%. That out of this 3%, how much is coming from net selectivity? The return from investors' risk or the return from managers' risk is something that is not much talked about. It is something which is built up into this model already. Though we'll still talk about, I would say, try to have a conceptual understanding about these two metrics as well. But broadly, the farmer's decomposition of the performance equation simply states the return from net selectivity is equal to the return from selectivity is equal to the return from net selectivity plus return from diversification. And here you can clearly see the return from net selectivity. This component is broken down. It's a sum of these two components. I'll repeat my point. The return from selectivity is simply a summation of the return from net selectivity plus return from diversification, and that we'll understand. Now, here also, it's very important to understand in case of active investing that which benchmark we are choosing or which index we are choosing. So in this case, the active fund manager chose large cap stocks. He might chose all the 50 stocks and change the weightages, or he might chose a few of the stocks out of Nifty 50 and change the weightages to deliver extra alpha for you. But if you have the mid cap stocks also in the portfolio, small cap stocks in the portfolio, large cap stocks also in the portfolio, the active fund manager portfolio की बात मैं कर रहा हूँ. In that case, Nifty 50 might not be an appropriate benchmark. In that case, you might have to take a Nifty 500, which is a broad-based index, the broader market index, which tends to encapsulate the Nifty 100 top 100 companies, the Nifty 150 mid cap, the mid-sized companies, and the 250 small cap companies. Correct? So index also matters the most. You need to take that benchmark or that index which tends to replicate the active fund manager. For a small cap active fund, you cannot take the Nifty 50 as the benchmark. A small cap fund will always outperform Nifty 50 as the benchmark. For that, you can take Nifty 150 mid cap fund as the benchmark for a mid cap fund, or a Nifty 250 small cap as the benchmark for a specific active strategy managing a small cap fund. So taking the benchmark is very critical, is of utmost important to maintain consistency, to maintain at least a fair benchmark in terms of valuation. So coming back to our topic, the farmer decomposition of the performance, and here we try to break down the exit return or the alpha into different components. So once we deep dive into the return from selectivity, which again is the most important and critical component of the farmer's decomposition of the performance, here we need to understand that what do we mean by these two terms. Firstly, I'll just erase this. The first parameter, or even before trying to understand this, let's try to understand the start first. For all of those who have a simple understanding about the CAPM model, the CAPM model, CAPM model के बारे में मैंने काफी बातचीत करी है. प्लीज रेफर लाइक वन ऑफ माय यूट्यूब वीडियोस. मेरी एक यूट्यूब वीडियो में, इन वन ऑफ माय यूट्यूब वीडियोस, आई हैव क्लियरली स्टेटेड अबाउट द CAPM model, that what exactly is the CAPM model. So a CAPM model, it tries to establish an equilibrium relationship. It tries to establish, so it says the cost of equity is equal to the risk-free rate plus beta into the equity risk premium. And here the equity risk premium is simply the market return minus the risk-free rate. The market return is the index return, the Nifty 50 return, subtracted the risk-free rate. That is the yield that you get upon a safer government security bond, a T-bill, a treasury bond, a treasury note, a treasury bill, right? The excess return that you are making, the extra risk that you are taking while investing into an index fund over making a fair, less return into a risk-free instrument, that is a government-based bond or a treasury bond. So the CAPM model or the CAPM model or the capital asset pricing model, it tends to establish an equilibrium relationship between the cost of equity and beta. Beta is the proxy for systematic risk, which is also called the market risk. To understand this deep dive, refer my video upon the CAPM model. Very important method if you want a very important concept. If you want to enter into the field of financial modeling, valuation, equity research, investment banking, CAPM समझना बहुत important है. ठीक है. अब this graph, it is showing you the relationship between the return on an asset and the systematic risk. And this line that you see, this linear straight line, is the SML line, security market line. A security market line is the graphical representation of the CAPM model. I'll repeat my point. This SML line you see, or the security market line, is a graphical representation of the CAPM model. Okay. Now, it says the return from investors' risk, the first parameter. And the return from investors' risk is simply RT minus RF. It is nothing but the return that an investor is getting by simply investing into a plain vanilla index fund. For example, a Nifty 50. That is, you are getting an extra return over investing into a risk-free rate. The extra return that you made over investing into a risk-free rate. So, for example, if a T bond in India gives you like some 7% odd, index fund might give you some 12% odd. So the exit return that you made while investing into an index fund, because an index fund is a composition of different equity stocks or instruments, which is much more riskier versus a risk-free bond, right? So this is the extra return that you have made versus investing into a risk-free bond. Then you have the return from a manager's risk. Now here the fund manager's intervention or your investment specialist intervention comes into place. Now, till this point of time, we entered into the phase of passive investing. But now we want to beat the benchmark. So here we enter into the active investing. Now, this is the return from manager's risk. If you invest into an active fund, you are taking additional risk now. Index fund is riskier than the risk-free rate upon a fixed income securities, government bond, or a T-bill. Active fund is much more riskier versus an index fund. The performance might go down versus an index fund, but if it rises, it might be fairly well or well above this index fund. So an active strategy can go in both the direction based upon the fund manager's call or market movements or the market exposure per se. Now, this is the extra return which the fund manager has made for you while investing into an active fund versus an index fund. The third component comes the return from selectivity. It is the fund manager's ability to select specific stocks which have given you alpha. And as the name also suggests, the return from selectivity, the fund manager has selected some stocks. His stock picking ability has been good, and some factor has been attributed towards the alpha. So alpha becomes a summation of the return from selectivity, the return from manager's risk, and the return from investor's risk. And further, the return from the net selectivity can be broken down into the return. The return from selectivity can be broken down into the return from net selectivity plus the return from diversification. Now let's understand what is the net selectivity. If you try to understand this graph carefully, right, the net selectivity is if a fund manager has taken additional systematic risk. In the most simplest sense, if we talk about the total risk for a portfolio, the total risk for a portfolio consists of systematic risk and unsystematic risk. The total risk जो भी portfolio का होता है, it is composed of systematic risk plus unsystematic risk. Unsystematic risk is the diversifiable risk that we can diversify by adding more stocks, having different exposure to sectors or themes. If one sector or theme is not performing well, the other sector or theme will do well. And the second one is the systematic risk or the non-diversifiable risk, which we cannot diversify. Market का exposure, market के risk की वजह से. So your total risk, it becomes a summation of the systematic risk plus the unsystematic risk. Now, if my total risk remains the same, assuming at a portfolio level, my total risk, it remains the same. At a portfolio level, my total risk remains the same, but I increase my systematic risk. So for a given level of same total risk, I increase my systematic risk. So that's my return from net selectivity. That is how much return is coming in my portfolio due to market exposure, maybe due to increasing the total market risk, right? But having the same total risk in the portfolio. I'm just increasing the systematic risk. मेरे portfolio में कितना return बनता है by increasing the systematic risk, right? But having the total same risk. And then you have diversification, that how much return the fund manager is able to get by while adding more stocks in the portfolio. Now this can turn out to be negative as well, which might indicate that if a fund manager is adding more stocks, the performance is getting negative. So you must stop at that particular point of time because even excess diversification is also bad. So this component of diversification simply tells the fund manager if the diversification or adding more stocks is giving excess return or making alpha for the clients. If adding more stocks is degrading the alpha or minimizing the alpha, then more diversification is not advisable in the most simplest sense. So simply the total excess return can be broken down into the return from selectivity, which further can be broken down into the return from the net selectivity plus return from extra diversification और inappropriate diversification और lack of diversification. अगर lack है then more diversification करो, excess है then कुछ stocks को बेच दो in the most simplest sense. ठीक है. So now we'll try to understand this with an example. Example से समझते हैं. I have some numbers. I'll be just writing in some numbers for you. Let me zoom in and we'll try to understand this with an example. Okay. So for example, the return on the portfolio is 14%. The return on the portfolio is 14%. The return on the market is 10%. Let me just note down the numbers from my file. The return on the portfolio is 14%. The return on the market is 10%. Maybe I can take a risk-free rate as 4%. The risk-free rate, it becomes as 4%. And maybe I can take the beta of the portfolio. The beta of the portfolio, it comes out to be 1.4. High growth investing, right? So from this, I want to know that how much is the return coming from net selectivity, diversification, and market exposure. Okay. So first of all, I need to find out the alpha because ultimately I'll be breaking down the alpha itself. मेरे पास alpha नहीं होगा मैं right में break down क्या करूंगा तो मेरे पास alpha होना चाहिए सबसे पहले. The one thing is I'll be calculating my alpha for the for the portfolio. ठीक है. The first thing calculating the alpha for the portfolio. Now in this case, my total excess return, my total excess return becomes how much? It becomes 14 minus not 10 but 4. Why not 10? Now people might get confused here. Sir, benchmark को तो beat करें ना, the benchmark is 10. The return on the market, assuming it to be Nifty 50 is 10. No. If you see that chart, you initially had the return from investors' risk plus the return from managers' risk. The return from investors' risk was RM minus RF, the return on market minus the return on the risk-free rate. The return due to manager's risk was the return on the active portfolio, which is RP minus RM. So broadly, if you see, your RP, the return on the portfolio, has beaten the risk-free rate broadly by 10%. So this becomes my total excess return. That's the component upon the left-hand side is sorted. Right? Now this 10% needs to be broken down into different components. Now, if I want to know the return due to market exposure और द रिटर्न ड्यू टू सिस्टमैटिक रिस्क मार्केट की वजह से कितना रिटर्न बना है मतलब मार्केट के अप्स एंड डाउन्स की वजह से पोर्टफोलियो में कितना रिटर्न बना है नाउ हियर द फंड मैनेजर स्किल इज नॉट क्वेश्चनड नाउ दिस इज प्योरली द रिटर्न ड्यू टू मार्केट नो एट्रीब्यूशन और आई वुड से नो क्रेडिबिलिटी और नो क्रेडिट कैन बी गिवन टू द फंड मैनेजर The return was made just due to the market movement, the market volatility, market or the market movement upside down. तो यहाँ से जितना भी 10% का ब्रेकडाउन जितना भी पैसा बना है दैट वी कैन नॉट एट्रीब्यूट टू फंड मैनेजर स्किल एंड दैट इज वाई ब्रेकिंग डाउन दिस अल्फा इज क्रिटिकली वेरी इंपॉर्टेंट इट सिंपली टेल्स यू हैज द फंड मैनेजर contributed towards the performance or not or is the fund just performing based upon the market exposure मार्केट की वजह से आपका फंड चल रहा है या फंड मैनेजर की एक्चुअल स्किल की वजह से आपका फंड चल रहा है एंड दैट इज वाई ब्रेकिंग डाउन यूजिंग द फार्मा डिकम्पोजिशन इज वेरी इंपॉर्टेंट ठीक है अब यहाँ पे सिंपली वी कैन यूज क्या द CAPM मॉडल करेक्ट तो CAPM मॉडल सेज इज इक्वल टू द रिस्क फ्री रेट मैं ऐड करता हूं प्लस बीटा इनटू RM माइनस RF RM माइनस RF आई गॉट अ 12.4%। ठीक है। अब इस 12.4% जो मेरे पास आया है, ये 12.4% जो मेरे पास आया है, ठीक है, व्हाट आई कैन डू इज आई कैन सिंपली सब्ट्रैक्ट द रिस्क फ्री रेट फ्रॉम इट, दैट कम्स 8.4%। सो 8.4% इज माई रिटर्न ड्यू टू मार्केट एक्सपोजर, फंड मैनेजर की स्किल की वजह से नहीं, मार्केट एक्सपोजर। और सिंपली आई कुड हैव डन, इफ आई सिंपली डू E10 में नहीं लेता, आई मेक E10 एज जीरो, देन तब भी मेरा 8.4 ही आंसर आता है, अगर मैं स्टार्टिंग का RF कंपोनेंट छोड़ दूं। बट जस्ट टू मेक यू अंडरस्टैंड, आई जस्ट यूज दिस RF कंपोनेंट। सो बाय दिस फॉर्मूला यू टेंड टू कैलकुलेट द रिटर्न फ्रॉम मार्केट एक्सपोजर, केवल मार्केट की वजह से आपको कितना पैसा बन रहा है। एंड व्हाई आई हैव सब्ट्रैक्टेड द रिस्क फ्री रेट, बिकॉज सिंपली आई वांट टू नो that how much due to the market performance, not the risk free rate. Your risk free rate is a return upon a fixed income security, a government bond. वहां से कितना पैसा बन रहा है मुझे उसके उससे बिल्कुल मतलब नहीं है। मुझे उससे मतलब है कि अपने मार्केट में पैसा डाला, एंड मार्केट के अप्स एंड डाउन्स की वजह से, मार्केट के सिस्टमैटिक रिस्क की वजह से, विच यू कैन नॉट डाइवर्सिफाई, हाउ मच रिटर्न यू मेड simply due to market exposure, pure market exposure, right? Now, अब यहां मुझे जानना है द रिटर्न फ्रॉम नेट सेलेक्टिविटी, द रिटर्न फ्रॉम नेट सेलेक्टिविटी। हाउ टू कैलकुलेट द रिटर्न फ्रॉम नेट सेलेक्टिविटी? द फॉर्मूला सिंपली सेज द रिटर्न ऑन द पोर्टफोलियो minus CAPM return. CAPM return is also called as the expected return. The return on the portfolio, the return, sorry, I did a equal to the return on the portfolio minus the CAPM return। RP मैं लिख भी देता हूँ, माइनस जो आपका कैपएम से एक्सपेक्टेड रिटर्न आ रहा है, द रिटर्न ऑन द पोर्टफोलियो माइनस कैपएम से जो आपका एक्सपेक्टेड रिटर्न आ रहा है, द रिटर्न ऑन द पोर्टफोलियो माइनस द कैपएम एक्सपेक्टेड रिटर्न। द रिटर्न फ्रॉम नेट सेलेक्टिविटी इज 1.6। 1.6 plus 8.4 gives you 10%. So, one way we can say this 1.6 we got, the return from net selectivity हमारे पास आ गया। 10% का हमको ब्रेक डाउन भी मिल गया कि दिस इज वी आर गेटिंग फ्रॉम मार्केट एक्सपोजर, दिस वी आर गेटिंग फ्रॉम द रिटर्न फ्रॉम नेट सेलेक्टिविटी, बट हाउ मच वी आर गेटिंग फ्रॉम डाइवर्सिफिकेशन? इफ आई फर्दर नीड्स टू ब्रेक डाउन दिस नंबर कि मेरा कितना पैसा फ्रॉम डाइवर्सिफिकेशन बन रहा है, देन मैं वो कैसे निकालूंगा? Now to break down this return into diversification, because again I want to know that how much due to diversification the fund has given you. I need to know the portfolio's risk and the market risk. The portfolio standard deviation or variance, or the market standard deviation or variance simply. Just before landing to that, now this 1.6% return has come from the manager selectivity, pure stock picking ability. प्योर स्टॉक पिकिंग एबिलिटी की वजह से दिस 1.6% कैन बी contributed towards the manager's pure stock picking ability, and that is something we need to understand. And 8.4% is coming from higher beta, pure market exposure, और हमने इसको और रिफाइन करके ब्रेक डाउन कर दिया है। नाउ अगर हम एज्यूम करें कि जो पोर्टफोलियो का रिस्क है, द पोर्टफोलियो का रिस्क इज 22%, और जो मार्केट का रिस्क है दैट इज 15%। पोर्टफोलियो का रिस्क इज 22%, पोर्टफोलियो का रिस्क जो है स्टैंडर्ड डेविएशन है वो 22% का है, एंड आपका जो वेरिएंस है वो 15% का है। ठीक है। अब रिटर्न ऑफ द पोर्टफोलियो ड्यू टू टोटल रिस्क, ड्यू टू टोटल रिस्क फॉर ऑल ऑफ दोज वर द स्टूडेंट्स ऑफ कॉर्पोरेट फाइनेंस और फाइनेंशियल मॉडलिंग वैल्यूएशन, CAPM का है। उसमें एक फॉर्मूला होता है RF प्लस RF प्लस RM - RF डिवाइडेड बाय मार्केट का स्टैंडर्ड डेविएशन इनटू पोर्टफोलियो का स्टैंडर्ड डेविएशन, और पोर्टफोलियो का रिस्क, PR स्टैंड्स फॉर पोर्टफोलियो रिस्क एंड MR स्टैंड्स फॉर मार्केट रिस्क। ठीक है, तो द रिस्क फ्री रेट प्लस द RM - RF डिवाइडेड बाय दिस होल ब्रैकेट इन दोनों के डिफरेंस को दोनों का डिफरेंस है RM - RF, इन दोनों के डिफरेंस को आप डिवाइड करोगे मार्केट रिस्क से और द मार्केट स्टैंडर्ड डेविएशन से इनटू द पोर्टफोलियो का स्टैंडर्ड डेविएशन. हाउ मच इज RF? 4% प्लस RM - RF. I'll divide this number by how much? By how much? 15. ठीक है, I can just simply put it into brackets. Like Excel understands कि ब्रैकेट को पहले सॉल्व करना है एंड देन हमें बार 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 नंबर पे आना है, राइट. इसका मैं निकाल भी दूं तो आई गेस वो तब भी सॉल्व कर ही देगा. 12.8%. 12.8%. नाउ इसमें से आई नीड टू सब्ट्रैक्ट माई रिस्क फ्री रेट. 8.8%. 8.8%. नाउ नाउ इसको भी येलो कर देते हैं. द रिटर्न फ्रॉम डाइवर्सिफिकेशन का फॉर्मूला लिख लो. द रिटर्न फ्रॉम डाइवर्सिफिकेशन. द रिटर्न ड्यू टू टोटल रिस्क. द रिटर्न ड्यू टू टोटल रिस्क कितना था? 12.8 माइनस योर CAPM रिटर्न 12.4. ठीक है, देखो ये आपका रिस्क फ्री रेट का कंपोनेंट हटा के आपको बता रहा है नंबर 8.8. इसको आप निकालो चाहे ना निकालो, इट इज फाइन, अभी के लिए मैं रिमूव कर देता हूँ. बट द फॉर्मूला फॉर द रिटर्न फ्रॉम डाइवर्सिफिकेशन इज सिंपली CML रिटर्न माइनस CAPM एक्सपेक्टेड रिटर्न. ये जो मैंने फॉर्मूला आपको बताया है ना, इस पर कैपिटल मार्केट लाइन का मैंने आपको ये फॉर्मूला बताया है, राइट. सो रिटर्न फ्रॉम डाइवर्सिफिकेशन इज 0.4. रिटर्न फ्रॉम डाइवर्सिफिकेशन इज 0.4%. तो हियर व्हाट इज हैपनिंग, ये जो 10% है ना, इट्स अ समेशन ऑफ 8.4 प्लस 0.4 प्लस 1.2, because this 0.4 has been adjusted from return from net selectivity and you get a 10%. तो ये जो आपको 0.4% आया है ना, इट्स अ पार्ट ऑफ 1.6 ओनली. The 0.4 is a part of 1.6 only. अलग नहीं है. So here we break down the total exit return or the alpha into three major components. Market exposure. This is simply coming from the stock market movements, ups and down. Pure beta return. Pure beta return. This is 1.6 is the return from net selectivity. It is coming from pure stock picking ability. And this is purely coming from diversification. Now, if this number had been negative, if this number had been minus 0.4 or had been negative, it simply states diversification is not useful. You have to sell off some of the stocks. And the fund manager will have to run this model based upon various simulations. That is, till which point of time he needs to continue selling off the stocks and which stocks to make this number break even, at least make it as zero or somewhere positive. Because excess diversification is also bad. It tends to eat up your returns. And less diversification is also bad because it doesn't give you returns. So both the sides हमें देखनी पड़ेंगी. So this is how the fund's excess return alpha can be broken down into the market exposure, the return from net selectivity, and the return from extra diversifiable risk. And the market exposure is simply what? The market exposure is simply what? Is taking into account RM, RF, and the return, the beta. The return from manager's risk and the return from investor's risk. उन सबका combination हम एक तरीके से बोल सकते हैं. It's simply your market exposure. Got it? So that's all for today. We'll meet up in the next session to discuss something new and valid. So see you soon in the next session. Thank you.